I'd like to introduce you to our panelists and hosts today. We have Susan Thompson, partner and licensed coach at Action Coach. Nathan Brinkman, owner and founder of Triumph Wealth Management. And Dan Berg, senior manager at Wagner CPA. And presenting for us today will be Dan Berg. So Dan, I'll turn things over to you.
Thank you, Kristen. Hope everyone's having a good day today. So for our Winning on Wednesday seminar today, we're going to be talking about, like Kristen said, roadmap for succession planning, kind of from a tax and accounting perspective. And just a reminder to everyone before we kind of dig in a little bit, it really does take a team of advisors when you're working on your succession plan and transferring your business. There's more than one component to it. It's not as easy as having one good leg on a stool. You need all three legs to make the stool sturdy and something that works well. So today, like I said, I'll talk about a roadmap to succession planning, looking at a tax and accounting perspective. I'm not going to get super detailed into different transactions. I'm going to kind of stay at a little bit of a high level and just address something that you should consider from a tax perspective, something to consider from an accounting perspective, and then walk through a few potential scenarios on ways to potentially sell your business and things that you should probably consider and just be aware of prior to those scenarios and approaching that situation. So, when you think about succession planning, there's a lot of questions, and some of the questions are things that you should be asking, and some of them are things that you should probably know the answer to, or try to have at least an idea of before you really dig in too much to selling your business. The first thing I put up here is I think it's important to start with the end in mind. Be ready to kind of ask the questions first and then get some answers on some of these items. Some of them you're going to be working with advisors on. Some of them you're going to have to answer yourself. If you're thinking about selling your business, it's important to know, like I said, where do you want to end up? Is it something where you want to sell for as much as possible in order to retire? Are you in a situation where you want to transfer the business to maybe family members? Maybe there's family members you want to transfer the business to, and the business has created a really good lifestyle for you. You've got enough wealth to retire. You've got nice retirement accounts. Maybe you've got real estate in your portfolio. You've got enough to live on, and you really don't want any more money from the business. Maybe you want to give that business to your kids. Maybe you want to give it to some key employees partially, sell part of it. So the first one here I have is how much do you need to retire? Nathan talked about this a little bit a few weeks ago on the value gap and looking at, what is the value that you ultimately want to retire and need to retire. Prospective buyers of your business. Susan talked about that a few weeks ago. Who are some of the buyers of your business? And, I kind of break it down into three categories that we'll touch on a few slides here, and really looking at, is the buyer of your business, is it either a third party? So maybe that's a competitor, maybe it's a private equity company, maybe it's a company that has, a regional company that's not in our region or your region potentially right now, and they're looking to expand. Those businesses many times are better off buying an existing business versus starting from scratch and trying to get a client base when they don't have any name recognition in that area. And the last thing I have on here is, does your business have value? We all hope, yes, our business has values, but where is that value? If you're a construction company and your bottom line every year, let's say, is 100,000, but you've got 2 million worth of equipment, the value in your business is more in your equipment than it is the cash flow that the business is producing. Now, if you're an accounting firm, you're going to have more cash flow produced than you're going to have for equipment. No one's going to want to buy all the old computers and printers and software that there's a dollar amount that you pay for those, But the value on those, that's not where the business is worth for a lot of professional service type companies. It's off of the income that's produced from the work that's being completed. So taxes is one part. I put here why. Every time you make $1, a portion of that's going to go to taxes. So some good things to think about, prior to selling your business is the gross sales price of a business is not going to equal your take home in the sale of the business. So that's kind of one thing to start with. If you're going to sell your business for $1 million, you're very, very likely not going to walk away with $1 million after that. So knowing what the tax side could be, that's different depending on how the sale is structured. Again, I kind of go back to start with the end in mind and looking at, if you know what you want to do ultimately with the sale of the business, how do you back into what's the best after tax benefit you're going to get? And like I said, there's a lot of factors here, but just a couple things to think about when you're selling a business and the tax impacts. The first one I put here is a stock sale. If you're going to sell the stock in your business, now this would typically be an entity that's structured as an S corporation or a C corporation. If you are part of a partnership structure, you can also sell your partnership interest and get some capital gain treatment out of that. But there's more details in a partnership when selling a partnership interest than there is with an S corp or a C corp. An S corporation has probably become the most common type of operating entity. So we work with a lot of different S corps. And from a tax perspective, again, why you want to do a stock sale if you're a seller is you get capital gain treatments on that sale. And the capital gain rates are significantly lower than ordinary income tax rates right now. Capital gains are roughly 15% on the federal side until you get to over 400,000 plus of income capital gains. Then it jumps up to 20% at that point. And at that same level, ordinary income taxes are a 35 or 37% rate. So you are better off as a seller if you're able to structure a stock sale that gives you a lower tax rate on that sale. An asset sale, generally that's got a better treatment for a buyer, because if a buyer is going to purchase the assets of your business, they can then depreciate any equipment they're buying or vehicles that they might be purchasing. And they can amortize the goodwill of a business. So as a seller, if you sell your assets, you're going to pay ordinary income tax on selling the equipment. So if I buy a piece of equipment for $100,000, I fully deduct it for depreciation. I sell it 2 years later for $50,000. My gain on that is going to be $50,000. Even though I paid $100 originally, I fully depreciated out that piece of equipment. So now for tax purposes, it doesn't have any basis. So if I sell it for $50,000, that would be a $50,000 gain. And that's commonly what happens in asset sales, is most businesses try to accelerate and depreciate quickly their equipment. So when they sell that equipment, there typically is a gain, and that is taxed at ordinary income tax rates. Now, a lot of businesses, when they sell, they also have what's called goodwill. And goodwill is something where, it's that intangible value. It's that customer list, that, name recognition. A lot of times there's like a non-compete agreement that goes along with selling your business. Any patents or trademarks or all of the intangible values, it's not a physical piece of equipment. And if you are selling goodwill, then you do have a capital gain treatment as a seller. One thing that kind of threw a big wrench into this, which is actually in favor of business owners, was historically when we've looked at how much are you going to pay tax on, you ultimately look at what money did you contribute to the business, what income did you have, what losses did you have, what money did you take out. And from there, we could kind of figure out what a gain would be. PPP loans did throw a little bit of a wrench into that, but again, it is favorable for business owners, where let's say your business got a PPP loan for 200,000, you would not have any tax in for federal tax purposes, or we're located in Wisconsin. So if your business is in Wisconsin, there's no negative tax repercussions for a PPP loan that gets fully forgiven. However, that does increase your basis in your stock. So I don't want to get too much into that. That gets a little bit technical. But long story short, for PPP loans, that did throw a little bit of a wrench into kind of following the cash in and cash out, because the PPP loan ended up being cash in, but there's no tax paid on that, which again, it is a favorable result for business owners. So just one thing I wanted to touch on here on the accounting side. Yeah, obviously I'm going to preach you want to have clean financial statements. You want to have trust in your accounting system. I'll touch on that a little bit on one of the upcoming slides when we talk about due diligence and what that means. But a common accounting term that you're going to have if you're selling your business either to an existing employee or if you're selling to a third party, working capital is a common term that comes up. And working capital is looking at what is a business current assets less its current liabilities. So what does that mean from a practical standpoint? If you're a business, working capital is essentially current assets. It's cash, it's amounts that customers owe to you, your accounts receivable, and it's your inventory if you have inventory. Those are really the three key components to calculate what current assets would be. Current liabilities, that's your account payable, that's credit card liabilities, that's accrued payroll liabilities, really looking at short-term debt obligations. And if you're selling your business to a third party, that third party is probably going to give you a dollar amount. So maybe they say we're selling the business for $1 million. But that third party is going to say, well, as a buyer, I want to make sure the business has some sort of working capital. So it's pretty common in these transactions to calculate some sort of average working capital. And what that is, a lot of times, this isn't always used, but it's kind of a common method where they'll look at the businesses. Okay, if we look at the last 12 months, what is your current assets minus current liabilities for each of the last 12 months? We'll take that average. That's the amount of money that we want kept in the business when we're buying this business. And the reason that buyers want this is they don't want to start taking over a business that's got no cash, no receivables, no payables. They're starting from zero, so they're going to have to kick in money just to get the business going. So, as I said in the third bullet point here, second bullet point here, it's commonly used when the third party's buying a business. This is going to be separate from the sales price, and it's going to determine, what amount can the seller keep or potentially needs to contribute back after the sale of the company. So let's just pick an example here and say that there's a business that has 100,000 of current assets. They've got 20,000 of current liabilities. 100 minus 20 is 80. That's the business's working capital. That's what the average has been over the last 12 months. Prior to the sale, the business owner sucks out 50,000 of extra cash. So when the buyer takes over the business, there's only 50,000 of current assets and 20,000 of current liabilities. And there's 30,000 of working capital. In that type of situation, the buyer is probably going to ask, and it's probably going to be on the purchase agreement. The buyer's going to ask, I need another 50,000 of working capital so I can get to the average of what we've had over the last year. So that is a term to be aware of. And this is something where this kind of gets projected when you're selling a business to a third party, and then it gets reconciled more so after the fact. So just another thing to be aware of is even when you have the business sold, there's still some back end things that have to get done from an accounting perspective. So And I'm going to walk through 3 different scenarios here and some of the things you'll want to consider from a tax and accounting perspective in each of the scenarios. This one is probably the most detailed one, and that's selling to an independent third party. So again, this could be a competitor. This could be, an organization that is outside of your territory that wants to get into your territory and buy your business. It could be a large company that wants to buy your business to expand their operations. So the first bullet point I have here is the due diligence process. So if you're selling your business and you get a letter of intent from, we'll say, ABC company, you look at that letter of intent, it looks all good to you, you're happy with it, you sign it and say, great, I'm excited to sell my business. In a lot of regards, the due diligence process, kind of how I look at it is you're basically looking at a nice new shiny car on the lot. And that car looks nice and fancy, it looks sexy, it looks great. The due diligence process is basically taking a look under the hood and looking at everything. It can certainly be kind of a personal process for a business owner because a prospective buyer, they want to look at, are your financial statements good? They're going to look at, what are your accounting processes? How do you do your invoicing to customers? How do you record your accounts payable? They're really going to dig into a lot of those details. And the due diligence process is certainly something where you're going to want a CPA working with you on that. You're going to want to work with an advisor on that process because it is a fairly detailed process and they really dig in. The second one here is an EBITDA review. We did, I had a presentation for this actually for our first one on Wednesday a couple months ago here. And EBITDA is earnings before interest, taxes, depreciation, and amortization. And that's oftentimes what a lot of these buyers are going to look at. They want to see ultimately what type of cash flow is this company producing, so I know what type of cash flow I'm going to be purchasing as a buyer. And then I did put this third bullet point here. Now, most buyers are not super interested in getting a valuation from a seller. They kind of want to evaluate that themselves. So if you're thinking of kind of putting your business to market and looking at selling your company, as a seller, you probably want to get a business valuation to have an idea of, okay, what's this worth? What should I try to be selling for? But as a seller, if you get a business valuation, a buyer is probably not going to be as interested. It's looking at, okay, the valuation you have says your business is worth $5 million. I'll write you a check and we'll be good to go. A buyer is going to want to probably do a little bit more, like I said here. They'll look at your EBITDA. They'll have a due diligence process that they'll go through after making their letter of intent. So they're not just going to look at a business valuation that a seller got and accept that. So current employees. Another way to sell a business is to sell to your key employees that you have right now. A lot of times these transactions are going to be a stock sale. And the reason for that is, if you kind of think about it, who are your key employees? Your business is created wealth for you over time. Your business has a value to it. A lot of your key employees aren't able to just write a check to pay for the business. A lot of your key employees probably aren't going to be able to go to the bank and get a loan to buy the stock in your business. If they were to buy the assets, that's a little bit of a different scenario, but that's a little more uncommon. Typically, a lot of these, I have in the second bullet point here, redeeming stock is pretty common. And what that means is that works best, obviously, if you have stock. So you would have to be a S corporation or a C corporation. There are ways to do this as well with partnerships. It gets a little bit more detailed from a tax perspective. But if you are an S corp or a C corp, or a partnership, you can redeem your stock or redeem your units in the partnership. And what that essentially means is you are selling back your stock to the company. So the company is buying your stock from you. I've had a number of these transactions over the last year or two where there's been key employees that are going to take over a business, but they don't have the means to just write a check to the business owner. So the business owner, in these cases, it's shareholders in the business. They're having the company pay them for their stock over a period of time. And the key employee or employees maybe just buy a couple shares of stock from the current owner. So they're paying for a small portion of it. But then when the owner sells all the rest of their shares back to the company, there's only a few shares left. And those shares are owned by those key employees or potentially key employee, depending on what your situation is. But these are typically seller financed. And what that means is you're not getting the big cash at closing and walk away with all the money. This is something where the business is going to pay you over time. So you are kind of the bank and you do get paid over time for selling your stock. From a tax perspective, this does work out fairly well because the gain is typically spread over a number of years since you're being paid out over a period of time. And also it is a capital gain treatment because you are selling your stock. So we have some situations actually where, again, PPP loans kind of had an impact on this over the last year, where values of stock increased with those PPP loans that got forgiven, and shareholders sold their stock in a company. But based upon the value of their stock, their gains were actually pretty small. And in a couple of cases, I had a case where actually a shareholder had a loss on the sale of their stock, and they're getting paid out over the next couple of years now, and all those payments are essentially going to be tax-free. Now that situation is not a typical situation, but it would happen if you've kept a lot of equity inside of a company. So the last piece here is, gifting to family members. So in this scenario, you're looking at, I've got a family business. I want to transfer it on to the next generation. A lot of time it's mom and dad, maybe it's grandma and grandpa, but they've created their wealth from owning the business. They've kept the money in the business over time and they've built it. Now they own real estate. Now they've been maxing out retirement accounts. They've got other cash set aside. They're at a point where they care more about the business name continuing and the business continuing its mission. A lot of times when you're growing a business, it's kind of like a kid. You grow it from the beginning, it keeps growing and develop, and the goal eventually is that the business is able to function on its own, and you're not there doing too much day-to-day activity. And if you are going to gift a business to a family member, again, because you're at a point where you don't need any more money and you don't desire to get a big check when selling the business, or if you're in a situation where, let's say, a business is worth $5 million, but you don't want that much, you only need $1 million to retire and meet your retirement needs. You may have some partial gifts there and gift to family members who are going to take over. So from a tax and accounting perspective, things that you're going to need a business valuation if you're going to gift. As part of the business valuation process, there are discounting methods that are typically used when giving to family members to try to decrease the value of that gift. This is probably going to become a more common trend. As of right now, the estate tax exemption, so for each individual, is roughly $11.5 million. But the current administration has some potential plans to reduce that, and the reduction that was talked about, there's nothing in place yet, but the reduction that has been discussed is bringing that estate tax exemption down to about $3.5 million. So that's the big difference between the two. So if you had an estate, let's say you're married and your estate was about $10 million. Under the current rules with $11.5 million exemption for you and for your spouse, you don't have a whole lot of concerns from an estate tax perspective. But estate tax can change, and that's a good reason to have good plans in place, because if the estate tax exemption goes down to $3.5 million per spouse, and then it's at $7 million for a married couple, and your estate's at $10 million, then you've got some issues and some things to consider. So I put no the annual gift exclusions for this. the annual gift exclusion that you can give to an individual is 15,000 per individual. So I'll give an example. My wife and I could each give 15,000 to one of our children, and we don't have to do any gift tax returns or any filings of any sort. If our gifts per person exceeded 15,000, then that's when you start triggering a filing, and you have to look at kind of gift and estate tax. So, like I said, estate planning is also involved depending on the size of the business. And there's a lot of situations where there are family businesses where simply the ownership is just transferred to the children or nieces or nephews, whatever it might be. But there's certainly situations where there's a kind of a partial transfer via gift and a partial sale as well. So all of those things can kind of factor in when you're looking at transitioning a business. So that's just a few things I wanted to touch on today and kind of look at, what do things look like if you're going to sell a business and what are some things to be aware of. Hopefully that provided a little bit of value and got you some things to think about, if nothing less. And next, we're going to have a roadmap to a succession planning from a financial perspective. Nathan Brinkman's going to do that in a few weeks here.
Dan, we do have a question that came in from an attendee. They're asking, after a few years from now, the PPP loan matter will be irrelevant, right?
So from a tax perspective, when a PPP loan is forgiven, you're not picking up any income on that, but what it does do, it increases your basis in your stock. So if you're set up as an S Corp or a partnership, if you put in $100 to a business, your business makes $500, you draw that money out, you got $100 of cash at the end of the day. You take that out, you've got no gain. With the PPP loan, it's going to have impacts for longer than that because you receive cash. It's not money that you physically put in, and you're not paying any tax on that. So it's a moot point as far as repaying a loan or as far as tax purposes go for the business on an operating from an operating point, but it will have favorable tax benefits eventually when the business is sold. So I know that's kind of a long-winded answer, but there are going to be favorable benefits for businesses that had fully forgiven PPP loans when they sell their business.
Great. Thank you, Dan, and thank you everybody for joining us. As Dan mentioned, our next session will be presented by Nathan Brinkman, and he'll be speaking to succession planning from a financial perspective. That's taking place on May 19th, and I'll include a link to register for that in my follow-up email with a PowerPoint and the recording. Thanks again, everybody, and have a great day.